Coming up today, stocks put in their best week since November, in defiance of higher inflation prints. Yellen's plans to bring bond yields down. That could support stocks. Big tech bounces back, and why now's a good time to travel to Japan. And welcome back to Click Capital, everybody. Happy Friday or Saturday, wherever in the world you're joining me from today. And just want to start off with a big thanks for everybody that hits that like button on these videos every day. You helped this channel receive a record amount of views yesterday on the video. And so I really appreciate all your ongoing support. And if you haven't already, hit that subscribe button and I'll keep doing my best to keep you updated and informed on what's really happening across financial markets. And so let's dive right in. I've got a really interesting one for you today. I'm going to show you some things that are about to happen in markets you may not realize that could have a big impact on things. But first, let me just run you through on the surface level of what happened in markets today and this week. So the S&P had a pretty sizable down week last week, finishing below 5,000, and we had a pretty good bounce here this week, actually coming up and getting a bit above 5,100 before pulling back in the afternoon. And this is what I've got as a bit of a near-term resistance zone, which is a 50% pullback from this most recent leg down. And just looking at the market color, we can see that bounce up the front in a lot of risk-on sectors. However, we've still got most of them, including the main indices, underneath the 20-day moving average. So we still have a bit of a short-term downtrend here. And so you might be thinking, why did the market bounce this week when inflation data came in worse than expected, along with short-term bond yields, like the 2-year pressing up against 5% here? That should have caused a bit of stock market weakness. Well, there's a few things that have helped that out. Namely, last night, we just got earnings from Alphabet. Google came in a lot better than expected, up in their buyback program, announcing their first ever cash dividend to be paid to shareholders, and the stock gapped up and held pretty nicely today, finishing up more than 10%, taking its market cap over $2 trillion for the first time ever. And even though Tesla came in with worse than expected results, it too had a bit of a bounce. Meta came off hard, but seems to have held the line there a bit, and same with Microsoft. Initially dipped on earnings, but it's bounced back pretty good here today, and we've had a bit of a strong bounce back in NVDA as well. And I had a swing short position in this stock as a bit of a hedge, which is pretty close to hitting the stop loss. However, doing better is the swing trade in discretionary, which we've got a target at the 50-day VWAP. But just getting back to inflation for a moment, there's core PCE year over year, coming in above consensus, like we were expecting after yesterday's GDP report. Month over month, actually came in line as expected. So it wasn't actually too bad. It could have been a lot worse. However, you got to keep in mind that consensus was actually expecting inflation to increase, which it did. And so the big picture still not looking too great, like we can see here in this line chart of core PCE. The sharp turn up in the 3-month annualized, now approaching 4%, clearly changing this downtrend we've been in for 18 months. And we can also see that in this chart here of super core inflation. Month over month coming in at 0.39% and 3-month annualized now at 5.5%. And a lot of that increase is coming from services and transport. So far, food in the orange here hasn't been doing too bad. However, you got to keep in mind what's happening in commodity prices now creates a bit of lag in the prices us consumers pay, anywhere from 1 to 6 months. And like we can see in the agriculture ETF fund, that's been in a really strong uptrend this year, already up more than 25% year to date. And now we've got one of the most important agricultural commodities, wheat, having a strong rip this past week. And so we may be about to see some more food inflation just around the corner. Not only that, but we were a little surprised yesterday to see GDP come in lower than expected, showing the US economy may be slowing down a bit, whilst we've got inflation ticking up at the same time. That's what's known as stagflation. Not a really good scenario for the economy, consumers, and most risk-on growth assets as well. As even though pretty much all levels of government are talking down the chances of higher inflation as we move closer to the federal election, just looking at the data, which is what I try and convey to you guys on this daily review every day, that's showing that inflation isn't going away and should make things tough on the Fed. And I'm sure you feel it as a consumer as well. The prices we all pay for our goods and services does not feel like they're getting any cheaper at all. And that was confirmed again today in the Consumer Sentiment Survey, coming in weaker than expected, with a lot of Americans showing they expect inflation over the coming year to rise at a faster rate, more than any time in the last 6 months. And that's because we're all feeling the pinch on the prices we pay for everyday goods and services. However, that's not the case according to Treasury Secretary Janet Yellen. She's confident US inflation will continue to cool, and she's even predicting that interest rates could moderate as price increases slow. And there's a good reason why she is predicting that, because just like the Biden administration put out a press release hinting to the market that they may release oil from the Strategic Petroleum Reserve to help keep a lid on the price of oil, and thus the price of gas consumers are paying at the pump, trying to get them feeling good going into the election, at a time when the Strategic Petroleum Reserve is at 40-year lows, and many analysts inside the industry say the US should be topping it up to meet its strategic objectives. The Treasury, led by Yellen, who works closely with the Fed, led by Jay Powell, I think are coming for bond yields next, in order to keep markets propped up, liquidity flowing, and conditions loose going into the November election. So she has control over what's known as the Treasury General Account, TGA, and you could think of that as the account where all the US's tax bills, revenue is paid into, and where they actually spend money out of. So kind of like their general operational cash account. And just after they've received a lot of their annual tax payments 2 weeks ago, the Treasury General Account has swelled to nearly $930 billion. And so in other words, they've got a bit of liquidity to play around with here. And so they can do a number of things with that excess liquidity. First, if they really wanted to fight inflation, they could reduce government spending, keep building the TGA balance as a way to drain liquidity out of markets in the economy to try and cool down inflation. However, they're actually doing the opposite, and we won't know exactly what they're doing until a few hours before the Fed meets next Wednesday on the 1st of May with that curious timing in which we could get a big move out of markets once we know the details on that. And so just like last time when the 10-year bond yield hit 5%, Yellen came out and shuffled their issuance policy, doing more short-term bonds to try and bring bond yields down, which she did. Now they're likely to target bond yields again, and they can do that by issuing much less treasuries, drawing down supply from the market, and potentially spending upwards of $100 billion to buy back short-term securities, similar to how a company buys back its own shares and reduces the supply out there. And like I said, Yellen works in tandem with Powell, who's also hinted at a reduction in quantitative tightening. And they use these complex buzzwords because most people then don't understand what it means. However, to put it as simply as possible, the Federal Reserve had been reducing their balance sheet by almost $100 billion a month, thus acting as a little bit of a liquidity drain on markets, which should help cool things down along with inflation. However, they're looking to reduce that potentially in half. In other words, giving markets a liquidity boost. Again, really curious timing as we head into the election. And in similar moves to what they're doing in the oil market, attempting to manipulate it and keep the price down, as in my opinion, Biden, Yellen, and Powell's mandate of keeping Trump out of office is more important to them than properly tackling inflation, as evidenced by their actions, where they have opportunities to tackle inflation, but they've kept their spending, liquidity, and financial conditions loose, and even signaling to the market they want to cut rates, reigniting animal spirits, and along with it, inflation expectations that may not bite till next year, in which time it doesn't matter if Biden's back in, or Trump may be presented with the prospect of then rates being hiked, toppling the economy into a recession. And for those of you who are still innocent enough to think that Yellen, Jay Powell and the like are really concerned with inflation and the general public instead of their elitist friends, here's a list of Janet Yellen's speaking fees, which are pretty much considered in the business world as bribes, because getting paid $292,000 from Wall Street market maker Citadel just to speak for an hour is clearly a ridiculous price. And so she's been paid over $7 million from the very institutions she's supposed to overlook and regulate, in what's clearly a conflict of interest, kind of similar to how Barack Obama ran on a campaign of anti-Wall Street and standing up for the little guy when now that he's left office, he actually does $400,000 speeches for Wall Street firms himself. However, who hasn't paid off Janet Yellen and is able to speak his mind a bit more freely is JP Morgan CEO Jamie Dimon, who isn't afraid to share a piece of his mind, even if it's the cold, hard truth. And he says the US has less than 50% odds of nailing a soft landing. And warning, don't get lulled into a false sense of security. And yes, he has been feeling this way for a year or two, but he's been around a long time and his instincts are probably better than most of ours. He said the odds of a soft landing, the market kind of prices it at 70%. I think it's half that. It looks a little bit more like the 70s to me, and I point out to a lot of people, things looked pretty rosy in 1972. They were not so rosy in 1973. Stock market went into a sharp crash in 73, 74, and that whole decade was overruled by inflation. Pointing out he sees similar things happening now that he saw back then in terms of oil, geopolitics, fiscal spending out of control, inflation, so on and so forth. They're all lining up the same. However, like I showed you, the stock market really didn't mind that prospect of stagflation this week. Some think the rally is just beginning and it's not over. And who knows, it definitely is possible. With the Treasury set to loosen financial conditions even more, bring down bond yields, keep the animal spirits alive, the Fed reducing quantitative tightening, again loosening financial conditions, keeping liquidity plenty, along with the Biden administration threatening to release oil from the Strategic Petroleum Reserve if it goes up any higher, and actually cancelled their recent buy order to replenish it as planned. The stock market should be well supported going into the election, and we may have already seen the biggest pullback this year of 5.5%. And in addition to government manipulation of markets, we do have some strong underlying fundamentals, especially with big tech. There is huge spending on AI. That's definitely real. You can see that with big tech earnings all coming in better than expected. And some like billionaire Ron Barron saying Tesla stock has bottomed and it's going to go up huge on the promise of more affordable vehicles. He's a secular bull on Tesla. He's been invested in it for many years, a big believer, and he thinks all cars are going to be EVs in 10 to 15 years. He also mentioned Tesla could make more profit by eventually selling its full self-driving FSD technology to other car makers, just like they've done with providing access to their network of EV chargers. And in regards to the cheap EV threat coming out of China, he said China's rising BYD competitor is the only profitable firm in the country and still does not make as much as Tesla, which I think is a pretty shallow argument against the Chinese threat, which I say is a big part of why Tesla has slumped this year. As they're overtaking Tesla in China, China first invited Tesla back in there a few years back, like they do with all industries. They invite the best in there, they spy on them, copy them, pretty much control them, take all the technology out, and then feed it into their domestic firms where they're now looking to dominate. They'll always have the labor cost advantage over the West, and they work like crazy around the clock. So their productivity is good, and now they're flooding global markets with cheap EVs, which is definitely eating into Tesla margins. And why he's had to cut the price and is actually getting a build-up in inventory. So long-term, he's still got the brand, the potential with robotics, other clean energy products, robo-taxi for sure. However, for the here and now, especially when it comes to affordable EVs, I'd say China's got Tesla beat, and that should continue to weigh on the stock for some time. And there's a look at the daily chart, kind of just sitting around the 50-day, still defending this earnings gap higher. But don't forget, they did miss on earnings by 8.5%, with year-over-year declines in revenue, which is not what you want to see on a stock with a PE of 43. Another big story in financial markets this week is the sliding yen, getting to multi-decade lows, making it a really cheap time for us here in the West to travel for Japan, as we'll get more yen in exchange for our dollars. There's talk of intervention from the Bank of Japan, which they haven't yet done. However, they may do next week to put a floor in the yen. And the reason for this is they've stopped signaling another hike. They've still got the lowest interest rates in the world. Their overnight benchmark at 0.1%. And so with the recent rise in US bond yield the last couple of months, that strengthened US dollar and weakened the yen, and which has kind of also been a pile-on from speculators, further adding to the move. And there's a look at dollar yen. Looks to have gone parabolic and a momentum rip here, starting to look like a meme stock. And there's a look at one of the biggest bull markets you didn't know about, gold priced in yen, which, believe it or not, in the last 6 years, actually up 188% in a parabolic uptrend. And that's because there's only a finite amount of gold in the world, but there's infinite amount of yen, as their central bank is also very aggressive with quantitative easing and printing more money. And just looking out to next week, what economic data we're going to get. Slow start to the week as usual. Get a bit of GDP data coming out of the Eurozone, along with inflation data. Got to look at US home prices on Tuesday. Going into Wednesday, manufacturing PMIs, and the big one, Fed's interest rate decision, which the market's priced 97%. They're going to stay and hold. That's pretty much a given. More important will be the language from Jay Powell. And just before that, what the Treasury comes out and announces plans, what they're going to do with their excess liquidity. If they signal to the market that they're going to put a huge amount, 150, 200, 250 billion back into the system, that could cause bond yields to dip and stocks to rip. Going into Thursday, weekly jobless claims as usual, and then the big one, like we get the first Friday of every month. A look at the jobs market, non-farm payrolls. US economy expected to have generated 210,000 new jobs in the month of April. Unemployment rate expected to come in at 3.8%. And there's a look at Fed Fund futures. Still was pricing on one cut this year in the last meeting just before the federal election, in which I'd say Jay Powell and Janet Yellen very much would like to do as well. Fear and greed index still in the fear zone at 42 here. And just diving back into the charts, we do have some more work to do technically. Still got more than half of all stocks in the S&P below the 50-day average, and we've still got the Nasdaq more new lows than new highs. Still got the VIX a little elevated here at 15. However, I'm expecting a new floor around 14.5. Unless the S&P can take out 5,200, I don't think we'll be going back down to 12 anytime soon. And there's a look at the 10-year. And so it's no coincidence that it almost peaked out at 5% to the tick, in which Yellen, in tandem with Jay Powell, did their work to talk the market back down in late October. Did a pretty good job of it. Reignited animal spirits, got the stock market really excited, parabolic trend for 5 months. As expected, that got inflation expectations back up, risk assets moving back up, asset inflation and the wealth effect then spills over into prices, commodities. Bond yields reacted to that with hotter inflation prints. However, we could be close to stalling out here on bond yields now that Yellen is about to work her magic again and loosen financial conditions. When, like I said, if they really wanted to tackle inflation, they would be doing the exact opposite. And so if that's the case, long-dated bond funds like TLT, could be setting up for a dip buy here. If yields are going to come back down, then long duration funds like TLT could have a pretty good rip on the back of that. And so I've got my eye on this one for a potential dip buy soon. And we've still got credit spreads holding up pretty good. You can see that in high yield bonds. The dollar's pretty firm. However, they want to get that back down. And there's the liquidity proxy Bitcoin, still tracking sideways, just consolidating around 64,000. Gold having a bit of consolidation. Same with crude. Another good rip for Chinese securities in tandem with clean energy, which may have put in a bottom here. We'll just see if the retest can hold. We can bounce back above the 50-day. As a look at international stock indices, Canada's TSX consolidating. UK FTSE actually ripping up to new highs. There's Germany's DAX consolidating just above the 50. China 50 looks to have broken out above this trend line. The Nikkei still having a pullback along with the Aussie 200. And so a bit of a bounce back and risk on growth assets today. You can see that in the spread of high beta versus low volatility and the spread of discretionary versus staples, even though inflation expectations are sitting at multi-month highs. I think the market may be looking forward to a nice liquidity boost from the Treasury and the Fed. Got the semiconductor climbing back to the 50-day and actually getting a bit of a pullback here in utilities. Growth factor was the best performing sector today, up a pretty healthy 1.8%. Little bounce there in cannabis ETF, trying to find support at 850. Apple's still looking soft, and one of my favorite ways to play the commodity boom, stock that I'm long, A-Mark Precious Metals, having a good day here. Was looking for a pullback to the 50-day to load up. Looks like we may not be getting that, close to breaking out again. And actually got some pretty big moves today in these market leaders like DraftKings, Vertiv actually breaking out along with Wingstop, and Abercrombie and Fitch actually climbing back as well, and the big banks just kind of hanging in there, not doing too much. Okay, so to sum up this week, we had a bounce back, even though inflation data came in hotter than expected. We've had some good earnings come out of big tech, even though the market sold off Meta. It's kind of held its ground a little bit. We've got short-term bond yields stalling out a bit, and I'd say Wednesday's going to be really important next week to hear what the Treasury is going to do with their excess liquidity in their general account. Also language from the Fed. Jay Powell should be really coming out and hinting at the market he could do a Fed rate hike or cut, and just kind of playing at both sides, and which could kind of cool down animal spirits and tighten financial conditions a bit. But like I said, what they should do and what they actually do are often two different things. And so he's probably likely to keep toeing the line of saying he's still waiting for inflation to come down lower until he can cut, and he wants to cut. But we'll also get news of the potential reduction in quantitative tightening, which is another form of loosening conditions. And so the key levels in the S&P next week will be this 5150, which we may come up and test, and we may just get another big green candle after we hear from the Treasury and the Fed on Wednesday. If not, we could still be in for a period of consolidation if bond yields still remain elevated, and we still make our way through the thick of Q1 earnings season. And that's all I got for you this week. Thank you very much for tuning in every day to the Daily Market Review and hitting that like button, and make sure you come back to the channel tomorrow, where I'll be uploading a tutorial video on how to short junk stocks, along with another deep dive into another stock I'm invested in, and I'll post that one on Sunday. Thanks very much, and I'll speak again soon. Cheers.